typically am having this discussion with all of my clients right now. What do we do at the end of the year, and what are we going to do next year to continue our success? So let's get going with the webinar. And so just quickly, a little bit of background on myself. I'm a partner with Raw CFO, Ari Hauser & Associates. We're an outsourced controller, bookkeeping, and CFO firm. We help companies with their internal accounting department. Very often we find that companies have not utilized their resources in this area very well, and still have the needs of high-level accounting knowledge, and they don't often have a resource internally to get that. So we are a company that can work on a part-time basis, and we've grown to be a company that also offers accounting department outsourcing. So we will have the entire accounting process within our firm for a company. So it's a little bit of background. We're located in Caldwell, New Jersey, and we provide C-level financial experience on an as-needed basis. Many companies aren't large enough to have a full-time CFO, so but they still have that need. So there's a slide here about my background. If you would like more information, we could forward the PowerPoint slides to you after the program is over. You can contact us to receive that. So here's the agenda for today, and there's quite a lot of things to go over, and we'll do our best to cover the things that are most important to everybody. If you have any questions, or you have something that you'd like us to spend more time on, you can always send a note in the comments, and we'll cover that at the end or as we go along if it's a question about a particular section. So first thing we need to know is, are we profitable? So similar to when you go to the doctor for your annual visit, you'll go to the doctor, and the first thing he does is he looks to get accurate measurements of your various vital information. And the same thing is true with your accounting information. You need to be prepared throughout the year, getting your books and records in order, and creating a process where your information is readily available and is accurate. So we'll talk about how to determine if you're profitable, if you're not profitable. What is the balance sheet, and why should I care? Many people who aren't professional accountants, they understand profit and loss. They understand money coming into a company, money going out of a company, but they don't really understand the full impact of a complete accounting system, and the balance sheet is a very important part of your financial health, and we'll cover a little bit of why that's important to you. Create a useful and realistic 2016 budget. This is the time of year where you have most of 2015's information available. You should be able to predict and set goals and figure a way to meet those goals in the coming year. The tax benefits of using Section 179 rules. This is a very underutilized aspect of the Internal Revenue Code. What this allows, this 179 section allows you to take an immediate deduction for certain purchases. And it's a thing to look at the end of the year to determine if you've taken full advantage of that throughout the year, and what you might be able to do even in these last few weeks of the year to get a deduction in 2015 you might not otherwise have been entitled to. And that leads to how to create a capital budget. So the financial budget is is what everybody understands. What money do I expect to get from customers next year? What will it cost me to produce that, and what will my profit be? But the capital budget is a little different. The capital budget speaks to how will I build my company, what infrastructure do I need in order to be prepared to move forward and achieve those goals in the coming years. And the capital budget typically looks out on a longer term than just 1 year. And then within that, there's always the question of buying versus leasing. Which is better? Which should I do? We're going to speak a little bit about that. And finally, we're going to talk about leveraging today's technology to support your business growth. And that will be a little more interactive discussion with Victor Liu, the president of Link High Technologies, and myself. So let's get started. And the first question we have is, all right, I want to know who's responsible for our profits no longer being obscene. This is a typical boardroom, typical company. Maybe the owner is speaking up here. And the thing I find notable about this, besides the fact that he wants more obscene profits, is the question appears to speak to the fact that they may not know whether or not they're actually profitable. And he's looking at point fingers before he actually gets to the facts and figures of it. So what is profitability? It's the ability of a firm to generate net income on a consistent basis. It is often measured by price-to-earnings ratio. Now, most business owners of a privately held company, they really don't have a price-to-earnings ratio that they can look to. That's more of a Wall Street terminology. So to get it closer to what is more meaningful to us, we'll calculate it by taking the gross margin, which is the amount of profit after your cost of sales. Depending on the type of business you are, you may have cost to develop your product, cost to manufacture or distribute your product, and you may have personnel costs to deliver your product or service. So we deduct those from the gross, from the total revenues to come up with your gross margin. The percentage of gross margin is a vital number that you need to know. You need to be able to calculate that on an ongoing basis and track it so that you know how you're performing, how your performance changes throughout the year. That's something that you should look at on a very, not a daily or weekly basis, but certainly on a monthly basis. You should know, how are our margins this month? Did we have more expenses? Or did our costs go up? Should we be looking at our revenue stream? Did we change something? Oftentimes, when a company is starting to have trouble, it's because their profit is not as robust as it had been because of a factor that maybe they hadn't considered. Another way to calculate profitability is return on sales. So what is the net income after all of your expenses, the overhead, the direct costs? You get to the end, what is your bottom line? So what is that return on sales? So if you have a return on sales that's 5% to 15% or more, you're doing very well. If it's under 5%, you need to examine what ways or what costs you may need to reduce so that you can have greater return on sales. So I prefer money in the bank. So money in the bank speaks to not only did my sales happen, did I keep my expenses low, but I billed my customers timely, they paid me quickly, and I have the money in the bank to expand my business. When you get to a successful company after many years, you'll find money in the bank is something that you'll want to preserve and utilize for growth and expansion. So the next topic we're going to move to is we're going to talk about how to develop a budget. So there are many ways to define what a budget is. Basically, it's a list of all of your planned expenses and revenues. It's a plan for saving and spending, and it's an organizational plan stated in monetary terms. So you look at your organizational plan. Where do I want to grow my sales? Where do I want to invest in my business? Those strategies, maybe you want to develop a new product. Maybe you want to reduce a product or a service that you're providing now that's not as profitable for you, or it's not growing. It doesn't have a good growth future. What companies will do is they will make a plan. They'll decide, spend many months deciding on a product. They will invest in branding of the product, packaging, all kinds of very technical items. But sometimes what they leave out is, what is the financial strategy for that product? And the budget is something that you can put into place for any product, any segment, or your whole company. And at a minimum, your business should operate on a budget that will provide for cash flow throughout the year. So the purpose of the budget is to provide a forecast of revenues and expenditures, and that is really, the revenue part is really the most critical, because most of the time there is a very clear ratio of cost to develop revenue. So depending on your type of business, if you're a service company and you have personnel costs, every year those salaries increase. So you need to look at the cost that you're charging your customers to determine if it's eroding your profit margin. So the revenues that you're going to collect, you need to look at on a very strategic method, looking at your current customers, your customers you're hoping to reach, and potential customers beyond that through marketing efforts. So once you have a good forecast of the revenues, then you're able to look at what are the costs related to that. Sometimes those costs are known. Sometimes you have to do some research to determine the costs. But you want to be able to maintain a strong gross margin so that you can cover not only your overhead, but provide a profit at the end. And then you want to enable, so the other purpose of the budget is to enable the actual financial operation to be measured against what you're doing. So the second key part is the measurement of how are we doing. We had budgeted and planned for this growth. Maybe the growth didn't happen. Did we incur costs now that we're not recovering from our sales? Do we need to look at what we're doing? So let's get a little bit into more detail of some of the specifics of what direct costs are we talking about. So we're talking about labor, particularly in service industries, but also manufacturing industries. You want to take those labor costs to produce your product or service and take them as a direct cost and as a ratio of what your sales become. You also have materials and supplies required to provide the service or produce the product. Tools, sometimes there's specific insurance involved, permits, depending on your type of business. Sometimes you have subcontractors. Many companies we deal with have a particular segment of their workforce that they aren't doing directly themselves. They bring in a separate company. You have to make sure that when you're utilizing a separate company that you still maintain the ratio of profitability on that work. Then there's other costs that are related to a project. Could be specific to a particular item in your revenue. So these costs are the things that we subtract from our sales to determine our gross margin. And that really is a very key element. And you want to go through your cost and see if they are adding to the production of the revenue, and if there's some way you can keep them lower and or make sure that your revenue is producing enough to provide the proper margins. After you come to a gross profit, the next thing that you have to consider are, what are my overhead costs? These tend to be the fixed costs that you really can't avoid paying, although sometimes you'd like to. There are administrative salaries, office, accounting included, general insurance, and medical insurance. As we all know, the medical insurance is an area that is in great state of flux, constantly increasing, and there's a lot of questions for companies. What do I do with medical insurance? Unfortunately, we don't have several days in this webinar to cover all of those fluctuations, but that's for another webinar. You have a rent cost. This is part of your fixed costs. If you have an office or you have a building with a warehouse or a production facility, these costs have to be borne by the company, and typically it's a fixed overhead cost that you can predict far into the future. Rent typically stays the same, with the exception of additional costs that might have to do with maintaining the building or clearing snow, things like that. Your telephone and utilities, those costs, while they may fluctuate, typically they're fairly steady from year to year, and they're also part of the overhead. You need those to function. Professional fees, you have to be selective about your practitioners, that you're getting the proper service, and you're paying a fair price. You may have education, seminars, trade, you'll have office supplies, and there are other general expenses that are related to just existing as a company. Pens, paper, everything that goes into maintaining a company. So after you determine all of your income, your direct costs, your gross profit, and your overhead costs, there should be a balance remaining. The next thing that's vital to the process is to track your monthly progress. So rather than wait until the end of the year and say, hey, how did our budget do? You should look at it periodically throughout the year. Maybe not the first month, but certainly in the first 3 months, you should be determining, hey, are we getting behind our budget already? And that could signal that you need to make some changes. You need to be able to produce detailed financial statements. This comes back to having a process that's working efficiently and effectively. Am I sending out my bills to my customers on a timely basis? Are they paying quickly? Are we strapped with debt? Do we have, are we using credit cards to fund our business? Are we paying our vendors timely? These things point to the health of a business, and we'll cover those in a little bit further in the presentation. You want to develop worksheets for each month that include your budgeted amounts compared to your actual amounts. Are we way over budget in an item? Is it something we should be concerned about? Some people actually, I have a client who's a contractor and doesn't have employees, works on his own, actually keeps envelopes and keeps track of each category on a very manual basis. It's something that is a system that works for him, but I don't recommend it. With today's technology, you can do a lot better than just keeping an envelope. But really, the basic budgeting in the old days, there was a lot of people who worked on a cash basis. They got paid in cash, they kept cash, and they had envelopes for their different expenditures, whether it was a personal budget where they had money set aside to pay for groceries, and they kept it in an envelope. And when they reached the end of that money, they had no more money for groceries. They had to take it out of a different envelope. And that's one way to look at your budget is, am I borrowing from another part of my budget to maintain my lifestyle or maintain my company's activities? So that's something to be cognizant of, and it's something that will lead to greater financial health, which again we'll cover a little bit further on. So the next section is a little bit different, but it is part of your planning process. The next thing that we'd like to talk about is what are some of the tax rules that can benefit our company. And one of the rules that is greatly underutilized is the use of the Section 179 election. This election allows you to directly deduct in the current year expenses related to the cost of equipment that you purchase for the use in your business. And this is a great benefit because it speaks to the time value of money. So the time value of money is a concept where $1 today is worth more to you than $1 in the future. So if you can take a deduction immediately for something and get a tax deduction for it, you're going to save those tax dollars today. Now, you may end up saving tax dollars, the same tax dollars, over a number of years if you don't choose the Section 179 election. But what happens if you do that is that you end up receiving less, because over time you would have had this money, you could have used it in your business, and it would grow for you. Whatever your return on sales, as we looked at the previous slide, the net income over your revenues is the return on sales. Now that return, if you're investing money in your business, you're getting a return on that. And so that return is typically greater than what you get in a bank, and certainly it's greater than getting no return over a period of years for the same deduction. So what items can you expense? You can't expense things that are not owned by your business. So if you're going to go out and invest in something that you pay for on a monthly basis, that's not something that is a capital item. So the capital items are equipment for purchase for business use, tangible personal property, desks, computers, monitors, and things of that nature. Business vehicles, providing that they're large enough, you can also apply this to it. A number of years ago, they put this in so that people weren't deducting their cars automatically. And now it's pretty much larger vehicles. That's sometimes why you see business owners driving around in very large SUVs. Then you have computers and software, providing the software is off the shelf. And what I mean by that is, if it's a package that you can buy at one time, even if it's quite expensive, you can deduct it under this method. But if it's something where it's a software as a service and you're paying a monthly application fee or a monthly per user fee, that would not necessarily be something that you could deduct in this manner. You would deduct your payments as you go or under the contract terms. And then furniture and office equipment are the other items. So currently, the cost of equipment, vehicles, or software that you buy, the current limitation is $25,000. Of that $25,000, assuming you have a 40% tax bracket, which you may have greater than that if you're in New Jersey, that you'll ultimately end up with a $10,000 tax savings. That money can be put back into your business and continue to grow for you in the current year. So after, it's supposed to say 15,000 in this slide, we'll have to correct that, but basically the cost of your equipment then on a net basis is only $15,000. Now in 2014, the deduction limit was $500,000. That was something that went back prior to the Obama administration, and it was carried forward, and then it expired in January of 2014. And on December 17th last year, Congress passed an extension, and it was signed into law that extended to the end of 2014. 2015 came along, it expired on January 1st. We don't know if they're going to increase it or not. The indication we're getting today is that it will not be extended. This was a tremendous benefit in the past several years. It also extended the purchase limit. So if you purchase over $200,000 in 1 year of items that otherwise would be eligible for deduction in this manner, then it actually phases out your deduction. So at a certain point, you're not allowed to take the Section 179 election if you've purchased more items. The previous limit being $2 million gave you a lot more leeway. But I do not expect that to continue. So the planning opportunity is to look and see what you might be investing in the next year or year and a half, and determine if it makes sense to get those items now, get the deduction in this year. Even if you don't have profit in this year, you can carry that deduction over to future years until it's used up by profit. This will reduce your tax burden, and it allows you to get those items in and start having them help grow your business today. So what's part of a capital budget? So we talked about some of the benefits of investing in your business, taking the tax benefit related to certain purchases. Let's talk about what a capital budget is. So the capital assets that you need to operate your business could be vehicles, machinery and equipment to develop, to manufacture your product or to provide your service. Large tools would be a capital item, and obviously office equipment, computer hardware and software, and leasehold improvements. If you don't own your building and you make improvements to them, you're allowed to deduct that over many years, and we call those leasehold improvements. So when you're looking at a capital budget, you have to determine, why am I making this investment? What will the return be? And that return on investment, that ROI, it's become a catchphrase for many people, but basically what you really have to do in a practical sense is say, am I taking vehicles, putting them out with a workforce in the field? Will that be beneficial to me more so than having them use their own vehicles? Sometimes it makes sense to utilize that. Sometimes it's a company benefit. It's part of a compensation package. But oftentimes, if your company is growing and you want to contain costs, you may want to look at, does it make more sense to own a vehicle or to have the employees utilize their own vehicles? Machinery and equipment. If you knew that you could produce 20% more of your product, you'd want to make an investment in that. One company we work with, they got a large contract. They needed to get equipment in order to service the contract. And they had to calculate what's the return on this investment. Does it make sense? Maybe this contract isn't going to benefit us. At the end of the day, when the numbers were all calculated, they went through a process and selected a manufacturer and got the equipment that they needed so that they could fulfill the contract. And now they are finding new ways to utilize the equipment that they acquired, and it actually will produce more than 20% because of the new capacity. Large tools. Some of my clients who work in the trades, whether they're plumbers or electricians or landscapers, they invest in tools to make their job more efficient. If you can save time on jobs, you know what they say, time is money, and money is good. So the large tools that can benefit your business, they're a capital investment. Do you decide to make that when you're on site at a job? It really is too late. You really need to anticipate ahead of time what things you might need before you begin an undertaking like that. So having a capital budget available for these type of purchases is really quite critical. Office equipment, sometimes you need to add staff or you need to relocate your business and you need more efficient workspace. That's part of your capital equipment, your capital budget, and it also, a moving budget could be involved. Computer hardware and software. We all know how quickly computers and technology becomes obsolete. If you're not planning now for the next obsolescence of your technology, then you're going to find yourself in a difficult situation. Many companies that we work with over the last 2 years, once Microsoft stopped supporting the XP machines, they stopped writing protective software to eliminate hackers from getting in and sabotaging your system. They stopped maintaining it, so any kind of bugs or issues with those machines were not going to be maintained or repaired. And some companies were in a dilemma. What do we do? Our accounting software, our budgeting, or our billing software is also running on these machines in a system that won't run on the Windows 7 machines. And they had to really make some difficult determinations of how they could move their company forward, and sadly some of them didn't prepare for this. They had to go out and borrow money in order to get new systems, new equipment, and it's something you really should consider as you're going through your budgeting process, to include a capital budget for these type of investments. Leasehold improvements goes along again with moving costs generally. You want to plan for that, and you want to maintain a healthy and safe place to work. So the importance of the capital budget is really to anticipate major costs that are coming down the road and build a plan for how to fund those and be prepared to execute the plan in a timely fashion without having to scramble around, figure out how you're going to pay for it, and be left with sometimes making difficult decisions that aren't in the best interest of your company. And what this leads to is, what are your options when you get to a point where you need to replace something? Do you have the cash set aside to purchase something outright? As any of us who have haggled to buy a car in the past, I know they like to say there's no more haggling, that you get the best price right away, but that's a good example. You go to a place, you say, I like this car, I want it in red, I want blue interior, I want a white stripe on it so it looks like the American flag, and you make your special requirements and they come up with a price, and then you work on the price to try to get it to be the lowest, and the last best argument you have is, hey, I can pay cash for this now, will you take this much? Very often you'll get a good deal if you have the money set aside. Sometimes you can finance a purchase. There's a cost involved with that, and that cost is a factor in how much acquiring the capital will cost your business. That the extra financing costs can become a burden to your company because they drop down to become an overhead expense that you now have to cover, and it eats away at your profitability. Then there's a lease versus purchase, which we'll speak about a little bit later. That's another element that is very important to determining how much will this cost us over the long haul and what's in the best interest of our company when we're making those investments. So you need to look at, when we're talking about ROI, in this sense, you have to look at your annualized profit. You have to look at what this will add to profit, or maybe it's a cost savings because you're doing things faster. The return is a savings in time, so that becomes more efficient and you have greater margins. So you want to take that annualized profit or cost savings, you want to divide it by what you invested today, and that percentage equals your return on investment. You compare that to interest rate on borrowed funds to acquire the asset, and you have to see if that percentage, that return, is going to be greater than the cost actually to invest in it. So the lease versus purchase decision. This is often something that business owners struggle with. They are, it's often confusing to them because there's different interest rates. The interest rate on a loan is generally stated, it's very clear, and it's very, it's sometimes negotiable. The lease elements sometimes are a little bit more obscure because basically what you're doing is borrowing that equipment or that asset. You're borrowing it for a period of time that you're under lease, whether it's 3 years, 5 years, or 10 years. So at the beginning there's a value, at the end there's a value, and what they do is take the difference in that value and they apply an interest rate to it, and that's what you're paying in a lease. So it's a little more difficult, more complex to determine the underlying interest rate in a lease. So some of the factors that you need to consider when you're considering a lease or a purchase is, who owns this thing? Is it going to be ours? Do we get it at the end? Do we have to pay something more to acquire it? What is the cash flow element of this? Am I paying a lower monthly amount if I lease it versus buying it outright? Can I put a down payment because I've saved some cash and get a lower monthly payment? Is that better than leasing? These things have to be compared. The interest rate, like I said, it's a stated rate typically in a loan, but when you're leasing something, it's an imputed rate. It's a very complex calculation, and sometimes that can be obscured to make it seem like the payment is very low. Then there's depreciation. So if I buy this asset, I'll get to depreciate it, but I'll be subject to the decreasing value. So over time, we've used it, it's worn down. At the end of a period of time where you buy it, you still hold that asset and you have to do something with it. Do I sell it? Do I keep using it? When does its usefulness become obsolete? When you're leasing items, you can use it for a time period that you're certain it will be functional. At the end of that time period, you can return it and have a new item, providing that the cost of the new item still works within your cash flow and budget. Financing options. Sometimes there are easier lease financing options than there are purchase financing options. It just depends on your overall financial health of your business. So one thing let me see what's next. So one thing I'd like to discuss a little bit before I turn it over to Victor and ask him some technology questions is we didn't really cover the balance sheet analysis I'd like to have covered. But basically, the capital budget took the place of that. Your balance sheet is your financial health. It's your financial health report card, if you will. It tells you how much cash you have, what your assets are. It tells you what your receivables are, how quickly, when you look into those receivables, how quickly am I collecting those? If I'm taking 90 days or more to collect my sales, then that puts a burden on the cash flow of the business, and some of that leads to a less healthy financial outlook or your financial report card. Then you have your liabilities. What are my payables? My vendors, are they paid timely? If you're not collecting your money quickly and you're paying your vendors quickly, your cash flow is going to suffer. It's just the nature of mathematics. So you want to be aware of how quickly you're collecting your receivables. And then you have your other liabilities. You could have, that's where you have the longer term debt. Maybe it's a loan. Maybe it's credit card debt. Those other things. All of that reduces the net worth of your company. And that net worth leads to your financial discussion, your financial health. And at the end, it's what equity are we building in this company? You want to look at the growth of that equity. So, Victor, I think now is a good time to have a brief discussion about some of the technology issues today and some of the solutions that we should be considering.
Oh, absolutely. Actually, before we go on that, I was just researching the internet during while you were talking, and Congress is actually still working on the Section 179 extension. They're trying to make it a $500,000 extension, and according to news outlets, they think they should be able to ratify it this Friday.
Yeah.
But we'll find out.
The 11th.
Yeah. Well, we'll find out Friday. If we find out, we'll email everyone, because Friday is when Congress goes home for Christmas.
Right.
And they don't come back until January. So it's either going to happen Friday or it's not going to happen this year.
Right.
The good thing is they're trying to make it permanent. So if they do pass it, it'll be a permanent $500,000 Section 179 for life. Well, my role really, especially with our clients, is really after someone like you, It's after you determine the profitability of your company and what budget do you set aside for technology. Some of the things I really want to point out is people have a tendency to really spend on what's, I guess, employee-facing, client-facing, which is great. It helps productivity, but I think bigger bang for your buck is really looking at your servers, your server infrastructure, security, which is a big concern, and your backup and disaster recovery. So buying a new laptop for a person, you'll get incremental productivity gains. But buying a new server, or at least upgrading your server, you're actually benefiting the whole entire company, right? And the same goes with infrastructure. Working on your network so it's actually faster, a little more efficient, benefits the company a lot more than just buying equipment. So that's something I see year after year, is whenever a client contacts me, especially in December, oh, we have $20,000, we like to buy all new laptops. That's great, but I would really want to do an assessment of your current network and see, are you going to get a better improvement if we improve the server rather than a notebook. And a lot of times, improving the infrastructure and the server will give you the same performance gains as a new laptop, and usually at a lower cost. Security, you really want to, if you have money, really see what security posture you're in this year and how you're going to improve it next year. We can work with you with your specific industries. If you have PCI compliance, other compliance issues, we can kind of determine that and help you budget it for next year. So now's a great time to spend what money you have left over. And like Greg said, this is a great opportunity to see what you spent in this year and really look at what you're going to spend next year for technology.
And when you mentioned disaster recovery and backups, a lot of people hear those terms and they don't really know what it is or if they really need it. One of my clients had in their office, somebody came in, could have been the president, could have been an employee, opened an email and had the crypto virus damage all of their files. So that's not a typical disaster that we see. Maybe it is, but sometimes people think a disaster, well, we're not going to get hit by a hurricane here, or our building's brand new, we're not going to have a fire. But it's more than those things that you have to be concerned about. It's attacks, cyber attacks, and things. How often do you think that we need to be testing our backups to make sure that our data is secure?
Well, I think on a high level, there's a common misunderstanding between backup and business continuity or disaster recovery. Backup is really not even the minimum anymore. Backing up just means you're essentially copying your data to some other location, and preferably offsite as well. So you really should have two backups, one local and one offsite. But that's not enough for at least our client base. Business continuity is what you should be playing for. Business continuity, on the simplest terms, really means the ability to continue to do business if your servers or your infrastructure is down. So really, I think every business, no matter what size and what budget, there's different levels of business continuity that fits almost every type of industry and every sort of budget. And then the testing is all important. Buying a solution without doing quarterly testing at a minimum of your files, it really means you don't have a solution. If you don't test a solution, you don't have one. And then if you're really testing business continuity or disaster recovery, you need to do a full test at least once a year. And a full test is fairly invasive, really needs, when we do one, we really need the client's participation as well as ours. So what we do is we'll spin up your server images at our data center, and then we rely on the client to actually log in and test, especially on the accounting systems. You really want to look at your balance sheet, kind of compare it to the balance sheets that you printed out previously, looking at trial balances, spot checking some of your data, your databases, because that's things that we can't do. We can spin up a server and say, oh, you can log in. But a true test is going beyond that and really working in it. And you know, that's something that everyone should do once a year.
Thank you. That was very helpful.
All right. Well, if what we're going to do is this webinar is recorded. Nikki will put it on our website within the next few days, and also it'll be on the Raw CFO website as well. And then if someone wants these slides, kindly send an email to marketing@linkhigh.com, and Nikki will be happy to provide the slides, you know, within a day or so. And again, if you have any questions, certainly on the financial side, you should really go to Greg Tomkins. Greg and I have worked together for over 20 years. He knows us very well. And if it's on the technology side, certainly contact me. And if you're not a client, I'm happy to discuss it with you over the phone or in person as well, some high-level things that you should be doing or your current IT provider should be doing as well. Well, I want to take this opportunity to thank everyone for attending, and everyone should join our mailing list. We have this. We're going to plan to do this once a quarter, more webinars, more lunch and learns. Thank you.